lots to kind of get into it. We saw these new ISM data, but let's get straight into it. I mean, you see the same numbers as me over here. And a few weeks ago, you predicted what you called the day of the top. What do you believe the market is fundamentally mispricing right now?
Yeah, several weeks ago we wrote, "What will the day of the top look like, and how will you know it's the top or probable top?" And so the important thing is what the game is. The markets are a game nowadays. They're controlled by the algo traders and the HFT. So that's all it is. They go
Mhm.
against the majority. When the majority is long, they go short. When everybody's short, they go long. So that's what the game is. Forget about all the fundamentals and all that stuff. These are the ripples. The big thing is, what will the big players do? Do you know that algo traders right now, they make up over 80% of the daily volume in the stock market? You know,
Wow.
how do you think? I mean, I know people that try to trade, day trade the markets. I said, how do you think you can really out trade with your laptop the computers of the algos, which can enter 90,000 trades, not shares, trades per second?
How has that fundamentally changed the market structure that you've analyzed for almost 50 years, Bert? I mean, do these
Yeah.
algos make the short squeezes and bull traps that you've described much more dangerous for the average investor?
Exactly. We never used to have these big, multiple situations where stocks are down 20 and 30% at the opening. This doesn't happen. There's no one in his right mind that would buy a stock that's opening 30% down. So this is all manipulation, and manipulation is supposed to be against the law, but here it isn't. So when we described what the day of the top will look like, said it's going to be like this. You're going to have a big down gap opening, as we have seen in individual stocks up to that time, but this time it's going to be the major indices, big down gaps, and that locks all the bulls in with losses.
Hmm.
People will not sell anything they hold at a loss, which is a big mistake when you're trading the markets. The markets, the first loss is the best loss. That's an old saying we've had for the last 50 years. And so when the markets open up down this big, everybody sits there and waits for a bounce so they can get out even. And getting out even is the most expensive exercise you can do. You
Hmm.
know, you want to take your loss when it's small. You don't want it to get bigger. And forget about the get out even, because they want to lock you in. And that's what the big down gaps that we had today, for example, do. They just lock people in with big losses, and then these people, they ride it all the way down. You have to remember that all the shares that are outstanding, they have to have an owner on the way into a bear market. When the market is down 50%, or some indices are down 80%, as they have been in other bear markets, somebody has to own those shares.
We know a handful of large tech stocks have driven the gains. Your letter notes about half the stocks in the Russell 2000 have no earnings at all. I mean, how vulnerable is the entire market when a few stocks are holding it up?
Very vulnerable. There's, the valuation measures, they're not timing vehicles, but they
Mhm.
tell you how vulnerable the market is. And the market right now is at all-time record highs, going back about 100 years. We've never seen such speculation as we have now. And those tops, they're always in place for a short time, and then the market goes south. So this is where we are right now. And
Interesting.
these record values, I cannot see how people can buy stocks that have a PE ratios or P sales price to sales ratio of 200 to 1, like a Palantir. Then you've got Snowflake and some of these other stocks. Price earnings ratios of 500. Do people even know what it means when you buy a stock at a PE ratio of 500? If all the profits of the company would go to you, if you bought the company, all the profits would take you 500 years just to get your own money back. No profit.
I got to ask you about some of the data too, Bert. I mean, the big jobs report is coming out this Friday, and your letter suggests that a weak report is coming and that it could prick the bubble. What are you seeing in the underlying labor data that gives you that conviction? I mean, if that's the case, maybe we're not at the top of the market today. Maybe it's then?
We have been in a recession for the last 2 years. Is being hidden by largely by the jobs numbers. We've written how phony the jobs numbers are. In January 2023, so that's 2.5 years ago now, there was a jobs report for January, and it just said 514,000 new jobs have been created in January. That's impossible. January is always down because seasonal workers they leave. And so we looked on the BLS website, their own website. We call it the BLS stands for Bureau of Lying Statistics. And and they showed 2.5 million job losses, not 514,000 gains. So the published number that was on TV was over $3 million wrong.
Yeah,
Can you
wild.
believe that? But people believe it. So luckily here, Mr. Trump and his people, they called the BLS on to task on this, and they fired the head of the BLS, which was really a very high time. But this is labor statistics, Jeremy. I'm
Yeah.
talking also about GDP statistics. All these economic statistics out of Washington, they are untrustworthy. You cannot trust them. They're as bad as those numbers that come out of China, and we have never believed the numbers out of China.
It was just a new report this morning saying India just cut $14.5 billion of U.S. treasuries in a year while adding those 40 tons of gold. And China has been trimming its holdings too. Is that proof that even bigger reserve holders are starting to lose faith? Or you
Oh,
think this is just kind of trying to make it more?
I think they know what's going to happen, what is inevitable. China has bought much more gold than the official transactions tell you. They're not reporting all of their gold buying, and so right now this weekend, in fact, at the SCO meeting, the Shanghai Group, we had. Basically, unification, which is incredible and very dangerous for the U.S. But India, and China and Russia. Now they're the best friends after this meeting this weekend. And we always try to prevent them from putting an alliance together. Now they are the best friends. Now this is together. These three countries have 36% of the world's population. That is a big amount, 36%. Do you know what the US is? US is 4.1% of the world's population. And this is where Mr. Trump is so wrong.
Mm-hmm.
He thinks that everybody needs the US consumer. Okay, he's wrong. What would happen right now, for example, if these three nations having 36% of the world's population say, we don't need to trade with the US. If they want to raise our tariffs to 25 or 50%, we don't have to trade with them at all. We don't need their consumers. We've got enough consumers outside of the United States. And in fact, we don't even have to do anything more. We don't even have to supply them with our stuff. We're just not going to even sell to the United States. Can you imagine if these three nations suddenly decide not to sell their stuff to the US? The shelves at Costco and Walmart, etc., Target, they're going to be bare. You know, because you take a look at all the merchandise you see on those shelves, turn them upside down and see where they're made. They're made in these three countries, most of them. So I think we are much more vulnerable to them boycotting the U.S. than us boycotting them.
Gold at an all-time high. We have a lot of people looking to that as kind of an alternative during this time in the economy. I'm curious to just kind of give me your gold forecast for our Kitco listeners, but also where does silver fit in? I mean, it's finally breaking above $40. Do you
Yeah.
see it as just a high beta play on gold, or does it have its own unique drivers?
Well, let me say one other thing. Money supply. Watch
Mm-hmm.
money supply. This is what put my business on the map in 1977 when the new Federal Reserve chairman, 1978, said, "We're not going to fight inflation with tight money. We're going to do it with higher interest rates." And I said, that means inflation full speed ahead.
Mm.
Okay, if you tight money, see, on TV, they propagate this fiction that tight money is rising interest rates. That's totally wrong. Tight money means when you go to a bank and you're credit worthy, and the bank says, "We know you're good for the money, but we can't make a loan to you." That's tight money. Okay. And that's what Paul Volcker did in 1980. Okay. But rising interest rates with loose money is wildly inflationary. And that's why in 1978 we wrote, we said, with this policy at the Federal Reserve, we're going to see double digit inflation, double digit interest rates. We predicted 20% prime rate, which the chief economist of Goldman Sachs, Gary Wanglowski, said was absurd. He said that in a seminar I went to, and I said, "Isn't it absurd if inflation goes high enough?" So we had a 20% prime rate in early 1980. Then the Federal Reserve got a little scared that they were being too tight. They loosened up for a few months. And then we watched money supply, but the seasonally unadjusted, the ones, the seasonally unadjusted means that they cannot fudge the numbers. Okay, those are actual numbers. And we noticed that in July of 1980, and said, "Oh, by with this policy, we're going to have a new record high in the prime rate, over 20% by the end of this year." On December 10th, 1980, we had a prime rate of 21.5%, new high. Okay,
Mm.
so this is what happens. So what you hear on TV with all of these shows from Wall Street is not real. Don't
Mm.
believe any of it. Don't believe any of it. Do your own thinking. You know, your brain has much more power than theirs.
Yeah. So I mean, you're saying that that instead, this will ignite a stagflationary crisis where both economic growth and the stock market kind of falter while inflation reaccelerates?
Yes, yes. And you know, you asked about silver. You're right. And I really hadn't recommended silver for some time, but I think a few months ago we said focus on silver right now because silver is also used as an industrial metal.
Mhm.
And silver had been lagging gold for some time. And so I said, it's time for silver to catch up. It's a poor man's gold, and silver is going to really outperform gold for a while. And I think we're starting to see that now. You know, so uh, uh, by the way, my long-term forecast in 1980 was the next top in gold in the secular bull market would be in the year 2031.
Wow.
Okay, so you still have some time.
I mean, let's assume that you're 100% correct and this crisis unfolds like you've called out these past corrections. I mean, what does the world look like on the other side? Is it a quick recovery, a long depression, or something else entirely?
Well, that is a huge question, and
Yeah.
it all depends on what the central banks do. You know, and the natural reaction for central banks is what they did in every other big calamity. They print money. That's the
Mhm.
only thing to do. They print a lot of money, and but we've got a problem right now. The problem already exists. We cannot sell long-term treasury bonds anymore to foreigners. It used
Mhm.
to be the foreign central banks were big buyers, especially China. Well, they're sellers now, you know. So who's going to buy all this confetti?
Yeah, yeah.
That
Oh,
is the
well,
big question.